Right now, thousands of American retirees are losing money they spent decades earning, not to scammers online, but to the insurance companies they trusted to protect them. A documented pattern of claim denials, policy cancellations, and coverage misrepresentation is costing seniors an estimated $13 billion annually. If you or someone you care about is over 60, enrolled in Medicare, or paying into any life or supplemental insurance policy, the information in this video could protect you from a financial loss that happens quietly, legally, and often at the worst possible moment. Stay with us until the end, because we're going to walk you through exactly what is happening, who it affects, and what specific steps you can take today to protect yourself. Let me tell you about Dorothy. Dorothy is 74 years old, lives in Ohio, and spent 4 decades working as a school librarian. She did everything right.
She paid her premiums faithfully every single month for more than 20 years. She carried a Medicare supplement plan, a small life insurance policy, and what her agent described as guaranteed coverage for life. When her husband passed away last year, she submitted a claim expecting to receive the benefits she had consistently paid for. What she received instead was a letter. That letter informed her that her policy had been administratively lapsed due to a technicality she had never been told about. Her claim was denied. $13,000 gone. When she contacted the company, she was transferred 6 times and ultimately told there was nothing that could be done. Dorothy's experience is not unusual. Hundreds of thousands of people across this country are facing nearly identical situations right now. So what exactly is happening, and how did things reach this point? This is not one isolated incident. It is a broader pattern of industry practices that strips money from seniors through confusing contract language, deceptive renewal processes, phantom coverage provisions, and what consumer advocates are describing as delay and deny tactics. These are situations where companies stall legitimate claims long enough that elderly policyholders either give up, experience declining cognitive capacity, or pass away before ever receiving a payment. In 2026, with inflation continuing to pressure fixed incomes and Social Security covering less ground than it once did, these practices are having a more severe impact than ever before. Here is something most people are unaware of. The life insurance and Medicare supplement industry operates under a fragmented system of state-level regulations. What is permitted in Florida may be prohibited in California. Insurance companies are fully aware of these inconsistencies and routinely exploit the gaps between them. Their legal departments are staffed specifically to identify the boundary between technically compliant and genuinely harmful. And for many years, those boundaries have been tested repeatedly. Here is where the numbers become deeply concerning. A 2025 investigation conducted by a coalition of senior advocacy organizations found that more than 60% of denied insurance claims filed by Americans over the age of 65 involved policies that were either misrepresented at the point of sale or contained hidden exclusion clauses that were never disclosed by the agent. 60%, that is not an anomaly within the system. That pattern is the system, and the financial scale is significant. The average denied claim for a senior over the age of 70 is approximately $22,000. Multiplied across hundreds of thousands of wrongfully denied or delayed claims every year, that is how the total reaches $13 billion. $13 billion that was promised to retirees, widows, veterans, and individuals with disabilities who fulfilled every obligation and received nothing in return. Now, there is a specific practice that has expanded significantly over the past 2 years, and it is called policy rescission. Here is how it operates. A person purchases a life insurance or supplemental health policy and pays premiums consistently for years, sometimes for decades. Then, at the moment they file a substantial claim, the moment the company would be required to pay out real money, the insurer's legal team conducts a detailed review of the original application. They are looking for anything they can use. A minor health condition that was not mentioned years earlier. A question that the applicant interpreted differently than the company intended. A checkbox that was not completed in precisely the right way. When they identify something, and their review process is designed to find something, they use it to cancel the policy retroactively. They return the premiums paid without interest and walk away from the payout entirely. In many states, under current law, this practice is legal. Consider what this means in practical terms. Imagine being 78 years old, recently diagnosed with a serious medical condition, and depending on your supplemental insurance to cover costs that traditional Medicare does not. Then you receive written notification stating that a discrepancy was identified in a years-old application. Your policy has been canceled, and neither party owes the other anything. This is not a hypothetical scenario. This is something that is occurring regularly across the United States. Now let us look at Medicare Advantage because this is where these practices have reached a much larger scale. Medicare Advantage plans, which are privately administered alternatives to traditional Medicare, have been among the fastest growing segments of the insurance industry for the past decade. By 2026, more than 54% of all Medicare beneficiaries are enrolled in some form of Medicare Advantage coverage. On paper, many of these plans appear highly attractive. Lower premiums, dental benefits, vision coverage, gym memberships, and additional features that traditional Medicare does not include. But here is what the television advertisements featuring recognizable retired celebrities consistently omit. A 2024 Senate investigation, a real and fully documented federal inquiry, identified systematic and widespread use of prior authorization denials across major Medicare Advantage insurers. Prior authorization is the process by which an insurance company must approve a medical procedure before a physician can administer it. Federal investigators found that these companies were denying medically necessary treatments at rates they characterized as alarming. Cancer treatments, post-surgical rehabilitation, dialysis. These denials were not based on clinical judgment. They were generated by automated systems. One former employee from inside a major insurer described the internal model as a denial engine, a system calibrated to reject claims up to the highest legally defensible threshold. Not based on medical necessity, based on profit targets. Here is the part of this that demands attention. These companies receive fixed monthly payments from the federal government for every Medicare Advantage enrollee they cover. That means every treatment they decline to authorize represents direct financial gain. Every prior authorization rejection is revenue. They are compensated to provide coverage and then generate additional profit by withholding it. The Office of Inspector General has identified multiple major insurers for exactly this conduct. Enforcement actions, financial penalties, and accountability measures have been minimal, because when a business model produces billions in excess revenue annually, retaining significant lobbying resources becomes straightforward. But here is something that most viewers have not yet heard, and this is the part that could directly protect you or someone close to you from a significant financial loss. There are specific rights that Medicare beneficiaries hold that insurance companies are counting on you never exercising. You have the right to formally appeal every single claim denial, every one of them. And documented statistics show that when seniors actually pursue Medicare Advantage denial appeals, which most do not because the process appears complicated and discouraging, they succeed more than 70% of the time. 70%. These denials are structured to produce discouragement, not to reflect genuine coverage assessments. There are also completely free resources available through state health insurance assistance programs, known as SHIP counselors, operating in every state across the country. These are federally funded advocates whose entire purpose is to help you navigate claim denials and challenge wrongful coverage rejections. The majority of seniors have never heard of them. That absence of awareness is not accidental. This connects to a significant legislative development in 2026 that retirees need to follow closely. Congress is currently considering new insurance accountability legislation that would establish for the first time federal standards governing prior authorization response times and denial transparency across all Medicare Advantage plans. If enacted, insurers would be required to respond to prior authorization requests within 72 hours for urgent medical situations, compared to the current industry average that frequently extends to several weeks. Insurers would also be required to publicly disclose their denial rates. Currently, you have no way of knowing how frequently your insurance company overrides your physician's recommendations. Under the proposed rules, that information would be accessible to you. The insurance industry has committed more than $200 million in lobbying expenditures since 2023, specifically to prevent this legislation from advancing and to keep these practices from becoming subject to public oversight. There is also something hiding in plain sight that is affecting seniors right now and deserves direct attention. Final expense life insurance, sometimes referred to as burial insurance, consists of small whole life policies marketed almost exclusively to older adults through direct mail, television advertising, and in-home agents. These products promise affordable and guaranteed coverage, typically ranging from $5,000 to $25,000, intended to address funeral costs and final expenses so that families are not left managing that financial burden alone. What many of these policies do not prominently communicate is a provision called a graded death benefit. This means that if the policyholder passes away within the first 2 or 3 years of coverage, regardless of cause, beneficiaries do not receive the full face value of the policy. They receive only a partial return of the premiums paid, sometimes with a modest percentage added. A senior who purchases a $15,000 policy, pays premiums for 18 months, and then passes away may leave their family with approximately $3,000, not $15,000. This provision is contained in fine print that an 82-year-old trusting a friendly agent at their kitchen table is unlikely to identify on their own. There are also widespread complaints involving policies marketed as requiring no medical examination and offering guaranteed acceptance. Both statements may be technically accurate. What is frequently not explained clearly is that nearly any existing health condition will trigger those graded benefit periods or activate exclusion clauses. The coverage itself is guaranteed, the payout is not. That distinction costs families thousands of dollars during their most difficult moments. If you or a family member holds a policy of this type, there is a specific question you should ask your insurance company today. Ask them directly whether your policy contains a graded death benefit period. Ask how long that period extends. Ask what the payout amount would be if a claim were filed tomorrow compared to 2 years from now. Request the response in writing. If something unexpected occurs and you do not have this information, your family will learn it at the worst possible time. Now let us bring this back to the broader context, because what is happening in 2026 is not simply a matter of corporate greed. It reflects a structural failure that is intensifying as the baby boomer generation moves into its most financially vulnerable years. There are now more Americans over the age of 65 than at any other point in United States history. More than 57 million people. That population represents the most financially significant target demographic in the insurance industry. They have accumulated assets, they live on fixed incomes, they are motivated by a desire to provide for their families, they extend trust to official documentation, and they are statistically the least likely group to aggressively challenge a denied claim. The industry is aware of all of this and has constructed business practices that reflect that awareness. The Social Security Administration reported that financial exploitation of older adults, including insurance fraud and misrepresentation, cost seniors more than $36 billion last year alone. Insurance-related losses represent a substantial portion of that figure. And unlike investment fraud or wire transfer schemes, insurance-related financial harm is uniquely damaging because it frequently strikes when a senior is most exposed. Following a death, during a health emergency, while grieving, while managing a serious illness. These losses occur at the lowest points in people's lives. So, what are the actual steps you can take right now to protect yourself? First, locate every insurance policy you currently hold and read the exclusions and benefit limitation sections completely. Not just the summary page, the actual policy language. If any section is unclear, call the company and ask for a plain language explanation. If they cannot provide one, treat that as a meaningful warning sign. Second, if you are enrolled in a Medicare Advantage plan, contact your plan directly and ask specifically what prior authorization requirements apply to the types of care you are most likely to need. Ask how long prior authorization decisions typically take. Write down every response, including the date and the name of the representative you spoke with. Third, locate your state's SHIP program through an online search. It is free. It is federally funded, and it exists specifically to help people navigate exactly these situations. Connect with them before a problem arises, not after one already has. Fourth, if you have received a claim denial, do not treat that denial as a final outcome. Submit a formal appeal immediately. The appeals process exists for a reason, and when seniors engage it, they win the majority of the time. The documented pattern of insurance practices costing seniors an estimated $13 billion annually is real. It is supported by federal investigations, consumer advocacy research, and thousands of individual accounts. But it is not beyond challenge. These practices succeed primarily because most people do not know they are occurring. Now you have that information. Disclaimer: this video is intended for informational and educational purposes only. It does not constitute legal, financial, or medical advice. If you have a specific insurance dispute or coverage concern, please consult a licensed professional or contact your state's SHIP program for personalized guidance.